Cisco reported their earnings and the stock is getting hammered because they announced that they were going to lay off 4,000 people, although they did say they could find some jobs for them within Cisco. Now, here's the thing. Jim Cramer and I have talked about Cisco over the years. There was a time you did not like his direction and what he was doing. Then you kind of said, oh, he's out of the doghouse. I'm pretty cool with what he's doing.
Started returning capital to shareholders, which was important in terms of dividend.
Here we're at a crossroads because they had a good quarter, but he's really talking the stock down. He's really talking the company down. But you're saying, I see a silver lining in this.
Right. I mean, first, we did a video earlier this week saying, listen, wait, and then buy it on weakness. I'm going to stick by that. I didn't hear anything that doesn't make me want to do that. We also told Action Alerts people, listen, take something off the table. We can't trade as aggressively as individuals might want. Why take something off the table and then put it back on? Because it now sells at 12 times earnings. That's basically what he did. The other stocks that sell 12 times earnings in tech are Intel, Microsoft, Oracle, IBM. Those are all in secular decline. This is still in secular advance because they're in mobile, they're in cloud, they're in internet, they're in storage. Those are all things you want to be in. The actual quarter was terrific, Deborah. The problem is that I think it was up 34% going into the quarter. And Chambers was still consistent saying, listen, ultimately we're going to do 5 to 7 revenue. Don't worry about it. Don't look at it day to day, which is why the stock's down less than it was in the market after the market last night. But you know what? I think it goes 23, 24 and you buy it.
Was he too good for it? Was it too good for its own good? And I know that sounds confusing, but what I'm trying to say is, were the expectations built up too high? Because he said that the revenue going forward would be, it was still good, but it wasn't what people were wanting.
Well, look, you're buying a 2.8% yield. That's terrific for a growth company. You have $50 billion in cash. The 4,000 layoffs because they make all these acquisitions. They have all these middle managements. You gotta trim them. I mean, I thought that made sense. It would be bad if he didn't do that. That's one of the reasons why you invest with John Chambers. And yes, I've run cold on John when he had all this cash and he wasn't giving a dividend. But the dividend's terrific. It can be boosted. There was the outlook wasn't good in the stock. The outlook wasn't as good as expected. But it wasn't the big slashing that a lot of people were talking about. I urge people to go through and actually. Yes, shocker. Read the conference call. If you did, you would understand there's about 90% positive and 10% negative.
Well, you know what? What I found positive was when he said that a lot of those employees would be reallocated within Cisco and not just focusing on they're out on the street.
Right. It's not just a chainsaw. One of the things that John has done, and he talks about this, is just acquisition after acquisition after acquisition. Well, if you're not trimming after you do acquisitions, you're ending up with a bloated company. And Chambers tries to run lean.
All right, well,
he's doing everything right. It's just, except for talking his stock down.
Well, there you have it. Instead of talking the stock down, Jim is talking it up. He's seeing the positives in Cisco's quarter, not the negatives, so you could buy the stock on weakness. That's Jim Cramer, and I'm Deborah Borchardt with The Street.